Do we have disinflation in America?
Yes, we've sort of got gathering disinflation in America. We've got the numbers this morning were close to what we thought, but it's nice to see the sort of the core services part of inflation coming down. But what I think I'm most interested in is actually, it's not actually the numbers, it's forecasting the numbers. Because when you're trying to forecast these numbers, you realize, okay, new car prices have basically been flat or down since the start of the year. And we're still seeing these huge increases in auto insurance and auto repair costs, but that's got to break. And same thing with shelter costs. Shelter is about 90% of the increase in CPI at this stage, but we know the rents have stopped rising. We know that there's a rising vacancy rate for apartments. So what we can see is the promise of future disinflation in these numbers, and we're really trying to forecast these numbers. And that's why I'm so convinced that inflation is going to get down to 2% on its own, with or without any help from the Fed.
In your summed statement, and you and I have talked about this over many years, including with Bob Goodman years ago, there's an underestimation of the x-axis. Are we underplaying in our what's going to happen next quarter, what's going to happen in Jackson Hole, what's going to happen to the meeting? Do we need to extend out our study a year out, or dare I say 2 years out, to get to a successful disinflation?
Well, for investing, you always should, because equity investing, and most of your viewers are interested in the stock market. It shouldn't be about the next year anyway. But yes, I think particularly this time around, I think that's the case, because what we know with inflation is it's very symmetric. It actually looks like the Eiffel Tower. It goes up and comes down in exactly that pattern. We saw it in the 1970s. We're seeing it again now, 40 years later. But it takes a little while to come down. And it's because of lags in things like transportation services, and particularly owner's equivalent rent. And so as we track this thing out, it's going to hit 2 on CPI and on core CPI by late next year. And that's the track it's on. So I think you have to wait for that to play out. And then you realize that, okay, where does that leave us? That leaves us in a low inflation, slow growth economy. I think the Federal Reserve will be cutting interest rates, obviously faster if we end up in recession. But I think you have to sort of look out beyond the volatility of inflation that we've seen in the last 2 years to realize that we're headed for a place of slow growth, which looks quite like a decade ago. I think that's really sort of a return to where we were 10 years ago.
If that's the case, why wouldn't you take a look at where markets are positioned and just load the boat with 30-year treasuries and say everyone's wrong? They think that inflation could get unmoored if the Fed is less aggressive. I don't.
I wouldn't back up the truck, because I think there are better opportunities in markets than 30-year treasuries. I do think that the bond market overall is better priced than it's been for many, many years. And I think there is a one-time capital gain there as rates come down, as people realize the Federal Reserve is going to have to cut rates. Because sooner or later, this economy will stumble. And a 4% 10-year Treasury yield will turn to a 3% Treasury yield, or a 2% Treasury yield, and people will make a capital gain. But I think there are better long-term capital gains to be made still in the equity market. Right. But I wouldn't be underweight fixed income right now. And within fixed income, I would be definitely long duration and short credit. I don't think you're getting paid for taking credit risks. You are getting paid for taking duration risks.